All good. Thanks, Ollie. Hey, Fernando. Awesome. Welcome, everyone. Cool. Well, we'll kick off here. Thanks so much for joining here this morning, this afternoon, this evening, wherever you might be in the world. I'm Sarah Nolet, and your host for today. We've got some awesome panelists coming up here to talk about scaling up soil carbon markets as part of National Ag Day and hosted here in Australia, although with a pretty global panel as part of National Ag Day. So repping my pride here with my I Love Farmers gear. And I'm sure lots of folks on the call are big fans of farmers. You wouldn't be here today. So I guess just a couple things from me before we get into the meat of the content. I want to hear who you guys are, but briefly, like I said, I'm Sarah from the Agthentic group, where we do advisory work across innovation and adoption in agriculture and invest in early stage agri-food tech startups through Tenacious Ventures. And this meetup is brought to you and wouldn't have been possible without the hard work of the Australian AgriTech Association, the peak body here in Australia for agri-tech, as well as SproutX, an agri-tech accelerator, Platfarm, an ag tech startup, and us at the Agthentic group. So thanks everyone for joining. And I've put up a couple hashtags and handles there, as well as some of the ones of the panelists. So hopefully we can get some conversation going on Twitter and social media. I'll also ask maybe someone can put in the link to join the AusAgritech Slack channel. It's a really growing and vibrant community here in Australia where there's things like a jobs board, there's chats with farmers happening, people are making connections around, setting up trials. So for anyone interested in connecting in with the Australian Agritech community, I think Ollie just put in the link in Slack. So definitely click that and all are welcome to join. It is National Ag Day here in Australia, and we're super proud to be hosting this event on National Ag Day and talking about something as important as soil carbon markets and how farmers can be rewarded. So really excited to be doing that, and of course want to acknowledge, as we do here in Australia, the traditional owners of the land on which we meet, and elders past and present across Australia, and hosting us today. Why are we talking about soil carbon markets? Well, of course, that relates to farmers. While I talk a little bit about this, as I said, I want to know who's in the room. So we might pop up a poll if we can, just to hear about who you guys are. It's great to see some intros coming in to the chat as well. But we'll ask, who are you? And then we'll ask where you're from. So go ahead and fill that out. You can see up here who we've got on the panel. And I guess in terms of soil carbon markets, there's a lot happening in this space. It's really exciting to be giving opportunities for producers to get rewarded, and exciting to see the new capital and talent and perspectives coming into this space. But it is, confusing and messy, and everyone has different levels of knowledge about what's happening in the space. Our panelists will talk way more about this in a second, but I just wanted to put up something that we pulled together to help maybe start orienting people to the different pieces of the puzzle, and to acknowledge that we've only got 4 folks on the panel here today, but there are many others on this call and listening in who are experts in this space across a range of these different areas. So there's different markets where you can be selling and buying credits. There's different methodologies, putting up the standards for those credits. There's project developers, like you'll hear from Green Collar today, with very different kind of approaches to doing this. There's service providers helping with the practice change and the auditing and the compliance and the monitoring and verification. And there's different technology platforms and providers in this space to enable it. So for those of you who are new to this space, a couple of the panelists have provided leave behind packs and additional detail. So we'll share a bunch of things as we put out content after this to help you get more up to speed. But for now, I think we'll dive right in so you can hear from the panelists. Let's see the results of that poll. So mostly, entrepreneurs, agribusiness are the leaders. We've got kind of 10% producers, some research, government, investors. Awesome. So as always, a range of different audience members, which is great to see. Cool. Well, we might jump in then to the discussion. I know that's what you guys all want to hear. So we'll start with Alden from Nori. And Alden, I will turn it over to you and you can wave or nod. Actually, I didn't mention how we'll run this is each of the panelists will give just a minute or 2 or 3 of kind of background on themselves, a couple slides, and then we'll drop down the slides and jump into discussion. Cool. Alden, over to you.
Okay, I intend to, as quickly as possible, hit you with gross generalizations that are controversial. And so we'll listen to the questions and concerns that people raise. And my commitment is I'll follow up with a comprehensive slide deck. That's my best shot at responding to those questions that we don't get to respond to herein. And bottom line is, I was the first person in the world acting for a buyer's group to ever sign a contract to buy carbon credits from farmers back in the 1990s. And at the time, we originally went to the science community and said, what do farmers have to do to provide us credible credits demonstrating soil organic carbon stock change? And the world's leading soil scientists, including Ratan Lal, Cesar Zerold, and Keith Postian, put a lot of work into it and proved to us that it was going to cost farmers $80 a ton, or credit if we think 1 ton per acre per year on average, to quantify and verify their otherwise valid claims. So we financed an exercise of getting the scientists together to come up with a better plan. And the plan they came up with after 4 years of research, which we funded, was the following proposal. Set up a network of, and there's 2 slides here I'll just go past, but existing carbon markets, including the leading ones, including when you look at the newest approaches people are promoting, still have a 3 to 5 year lag between when you pay to register your project and when you get your first credit issuance, and a 1 to 2 year lag before your first credit sales. And to date, worldwide, if you look at all of the carbon registries, including Gold Standard, Verra, and CAR, just 36 to 48% of all the credits that have ever been issued for sale have not been retired or bought. So it's not exactly what you call a success story. So we're trying to say, how do you get that lag out of there? How do you get the upfront costs out of there? And how do you still get a credit that's credible? So move on. And this is a good news, bad news story. There's lots to learn. The answer we discovered, which we still hold to as the Bible, is collaborate, government and the private sector, to set up what we call a network of soil sample reference or experimental sites. So step back and look at your soil maps, your land use mixes, precipitation zones, and say, what's the smallest number of sites that you want to do very, 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 very comprehensive and expensive soil sampling and testing on a predictable and good cycle, so that the data that is coming out of those sites informs a model and enables you to extrapolate the information you get out of that reference network to the extent that you can really be producing with the related model estimates of soil organic carbon stock change in response to different land use changes with uncertainties of plus or minus 25% to 40% are acceptable. We can make a market work with uncertainties that large if we know the uncertainties. It's not knowing the uncertainties that shuts us down. We do believe that if you set up such a network and then you are filling in data gaps with the data that's being reported by the market project participants over time, it doesn't take more than 10 years to get the uncertainties that measure plus model strategy produces you down to 12% to 20%. Now, to put that in context, next slide, please. There's a whole bunch to talk about one day. Hopefully we get to that. But if you're actually doing, basing your soil organic carbon stock change estimates on point in time soil test results that are executed, in fact, the way that is being prescribed by new protocols in the United States and in Australia, you're still getting estimates that have plus or minus 20 to 40% uncertainties. You're just paying somewhere between 15 and 50, the first 15 or to $50 a ton that you get paid for your credits, or your aggregator gets paid, is just paying for those exercises of quantification and verification. I'll give you some numbers. I don't know the numbers from Australia, but I want to challenge you with my last slide. And in the United States, if we set up a network of 6,000 experimental test sites to inform a model like Comet Farm, which right now only has 1,200 experimental test sites, and we found ourselves with a carbon market where the annual turnover was 20 million credits, they're NRTs in Nori language, then the cost of maintaining the infrastructure that is giving us what we consider reliable enough estimates actually runs down to about 69 cents a ton. So the question I'm asking is, why are we spending tons and tons and tons and tons of taxpayer resources to build a methodology that costs $15 to $50 a ton to maintain, when there's an option available to us that's going to cost $1? I also am adamant in my assertions that all of us in the marketplace should be encouraging our governments to put their seed funding into establishing that infrastructure, so that it's up and that the private sector can take on the cost of carrying it when the government funding dries up. Because we got the prescription right in Canada in the 1990s, and the US Comet Farm team got the prescription right in 2002. And in every case, sorry about my doggy, in every case, even though the business plan was right, government cut the funding before it was executed completely. And let's just assume government funding is going to dry up before it's executed completely. Let's not get the government funding very expensive site-specific soil sampling and testing, because when the government funding dries up, we haven't created the infrastructure that is efficient enough for the private sector to take it over and keep it rolling. Can I go to just the last slide? And here, because I want to challenge Australia, I'm not familiar with your marketplace, but I love that there's 2,000 sites where soil samples have been taken to date. But the interesting thing is, when I look at the maps of where the sites are that soil is being sampled, that's in the right hand, and the map of the existing approved projects in Australia, and the soil map where the more promising places to place projects in soil sequestration potential are those light green and orange yellow areas. What I see of the 2,500 sites that Australia's already got sampling data, 1% to 2% of the total sites overlap the regions that have the greatest potential and the greatest population of projects. So I think if you step back and did a very sort of intentional statistical analysis saying, how do we set up the representative reference of sites, you'll need way less soil sampling and testing sites than you are maintaining already. I'll stop there.
Thanks, Alden. That's a lot. I'll remind everyone in the audience to put questions into the Q&A so that we can capture those as well. And we'll definitely get into what's happening in Australia a bit more with our next panelist. So Sam Duncan, founder and CEO at Farm Lab. Just again, Laurie, it looks like you put a question in. If you guys can put questions in the Q&A, not in the chat, I'll make sure to curate them so I don't lose them in the chat. Thanks for that. All right, Sam, you're up next to talk about Farm Lab.
Thanks, Sarah. Hopefully everyone can hear me okay. Looks like my microphone is working, which is good. So I'm Sam from a company called Farm Lab. So we provide sort of that, I guess, architecture that Alden was talking about to help consultants, agronomists and farmers view and manage their soil. So if you're familiar with something like Xero accounting software, we kind of do that for soil. If you want to click onto the next slide. So what we provide are soil maps to our users. There's a little gift there, but I don't think it's
yeah, I think I've got it in PDF, Sam, so I think I messed you up. That's my bad.
That's fine. But you can sort of see the farm there, and what we do is we work with the soil testing labs to integrate the data into their cloud system, so that for a farmer, they can see all their soil test results. across their farm. Normally it's done through agribusinesses and advisors. So we work through them as a distributor. And I do notice there's some, got some local producers in the audience currently using FarmLab. So yeah, so good stuff. So what we're looking at specifically in terms of carbon are helping to build these models, these hybrid sort of models to lower the cost of soil carbon measurement in particular. But we really believe that it goes hand in hand with a lot of the standard sort of agronomy that takes place across a farm, because you don't just set out to farm carbon. Most of the time you also farm something else like cattle or crops. So, you know, these two things really need to go hand in hand. And when it comes to managing the soil, they also sort of, you know, we need to be realistic here. We're not just managing carbon across the landscape, we're also managing fertility and other bits and pieces. Fortunately for us, and, you know, the science is pretty clear on this, is they go hand in hand. Yep, if you want to flick to the next slide. You know, this is just, this came out of a World Bank report from last year. These are the amounts of carbon credit transactions that took place. It's a really ugly chart. If you know me, you know I love data and I love charts. So I'm sure some of you in the audience will absolutely love this. Others, this is pretty horrible to see first thing in the morning before your morning coffee. So just to cut to the chase, that little circle is how many credits are being traded that were produced by agriculture. So it was hard to calculate, but that's about 2.5% of global credits being traded. Absolutely nothing. Most of the credits being traded across global markets right now from renewable energy and industrial gases, which is a bit of a shame given the potential for agriculture to sequester carbon. Agriculture and soil being, you know, the largest pool of carbon managed by us as humans. So if you want to flick onto the next slide there. Let's talk about some of the realities of managing carbon. Now, Alden sort of touched on this, and I think David's going to go into this in a bit more detail, but, you know, we're not doing it really across Australia. I think at last count, the last I saw, which is probably it's probably a few months old now, but there were only 68 soil carbon projects across Australia are accumulating carbon credits. Now that's soil carbon, not carbon credits generated through other things. But it's not a whole lot, particularly given the Australian methodology has been in existence since 2012. And why is that the case? It's really important that we look at some of the, I guess, or consider some of the, I guess, real behavioural challenges around sequestering soil carbon and entering into these projects if we're to ever solve this problem and to get uptake across agriculture and across farmers and producers for carbon credit projects. Now, there's two things I've flagged here, right? First is that soil carbon projects are relatively expensive, which Alden has gone through in a lot of detail. I think he said $80 a hectare to improve soil carbon. And, you know, we estimate the projects we see are about, it costs about $50,000 to undertake baselining as part of those soil carbon projects. So it's not cheap. And then the risk reward itself is also not proven. We have had some soil carbon credits be issued. Some of the first carbon credits were issued probably 6 to 12 months ago now, I think, through projects down in Victoria, which was absolutely fantastic. So that's starting to change. We're starting to see, I guess, our heroes in this space, the producers that are actually, you know, able to go out and say, this worked for me, which is a real fundamental barrier to overcome in terms of the adoption of these projects, but they're still super expensive. And the reason for that is because the Australian government are very aware of this, but the method for measurement is very conservative. And so there is a lot of change going on. I won't dive into that too much, but around the development of modelled and hybrid methods, which is something that we are really interested in from FarmLab, and we really want to provide, because we think that, you know, for producers, it's like, you know, as a small business owner, if I came to you and I said, hey, look, you know, if you pay me $80,000, I might give you $1 million 10, 15 years down the track, right? Now that's really good, but, you know, are you going to, for a small business owner, are you going to be around 10, 15 years down the track? What do you have to do to get that? And there's all these regulatory things in place that are really restrictive. So for the, you know, putting this back into the farmer's perspective, for the farmer to enter into these 15, 20, 25-year projects, there is a lot of risk there, which can be really off-putting, I guess. for the farmers that are already doing it, and there are, a large portion of farmers that are already doing this without, without the monetary reward. And I'm talking about the regen ag farmers, the ones that know, that have seen the benefits, the environmental benefit of improving soil carbon. And that's great, but, how do we reward them for what they've already been doing? And so there almost needs to be maybe a cheaper, no-cost mechanism to reward people that are already doing the right thing, because there's also a lot of information we can draw from what they're doing to bring back into sort of the mainstream carbon markets. And lastly here, we've spoken enough about the models. We've got these modeled approaches, but they're relatively inflexible, as all this says there. If you want to figure out the next slide there, Sarah, that's it. So that's it for me. Happy to take questions, and hopefully that was useful.
Fantastic, Sam. Yeah, thank you. Awesome. We will keep kicking on here to get everyone's perspectives and then jump into some discussion. I see the questions coming in, so thanks, guys, for that. Dave, for COO at Green Collar, you're up.
Thanks, Sarah. Thanks, everyone. Nice to all see you on a Friday morning. Just following on from what Sam said, just to give you a bit of context about Green Collar. So we're a project developer, we're an environmental markets company, and we're very much a purpose-driven organisation, but profit for purpose. Our overall mission statement really is that public finance alone is not enough to solve complex environmental issues, and markets play a very important role in, trying to achieve and tackle those challenges that we're all facing. And that's a sort of key golden thread of our business. Sarah, can you just flick onto the next slide? Great, thanks. So who's Green Collar? So we work across the environmental market space. So we're not only a carbon project developer, we work across the water quality space, biodiversity, and obviously the carbon space in particular. But what we're all about is rather than implicitly seeing benefits come from different land use changes that farmers and land managers can undertake, we're all about explicitly pricing and valuing those, environmental assets and ecosystem services that can be developed on a property. In the carbon sector, we've got approximately about 140, 150 projects covering about 10 million hectares of land, so a bit more than the 5 that's on that slide. We work cross-jurisdictionally, so in all states of Australia. We focus very much on nature-based solutions at the moment. So we do a lot of method development work ourselves. So we've written methods under the VCS, under improved forest management. We've written the most widely used method under the Carbon Farming Initiative Act in the Australian compliance market. And we also take a leading role in technical advice around other methods that are focused in the land sector. In terms of our sort of tonnes of abatement, we've delivered close to 23 million tonnes of abatement in the Australian market, which is close to half of the entire land sector's carbon abatement for Australia's national accounts, which is something we're really proud of. In terms of clients we work with, no surprise, our clients are generally pastoralists or croppers or graziers in all different landscapes of Australia. And we work in a collaboration model to develop projects on their properties that very much align with, their 5 and 10 year management plans in terms of what they want to see their enterprise doing over those few years. In terms of working with the government, we do work very closely with the government. At the moment, we've got 65 million tonnes of abatement, which is contracted under the Emissions Reduction Fund, which is the sort of federal government's main sort of legislative framework for tackling climate change, particularly in the land sector. And as I mentioned before, that slide's probably a bit outdated, but we're close to 22 million tonnes of abatement that's been delivered. A big focus for us, and I think it goes to the point around some of the balancing issues around the soil carbon market in particular, and the cost issues, is we're very, very much focused, on the integrity of the product that we're looking to deliver. So it's extremely important that, stakeholders within the ecosystem that we work can have faith in, the robustness and the transparency and the authentication of the offsets that we're generating. And in particular, when you're working in the land sector, it's about understanding how your projects impact those in and around the communities that we operate. So it's very much about working with local communities where they're traditional owners. We do a lot of work with traditional owner groups, regional communities. How are these projects impacting on other environmental assets whether that's around biodiversity. And most importantly, we want to make sure that these projects that we're developing are helping improve agricultural production. It's all about how does it tie into this sort of regenerative agriculture type approach that we're starting to see happen much more these days. Just, I think, to sort of hear a bit more about the recent investment that KKR, global private equity firm, invested into Green Collar under their Global Impact Fund, which was an extremely exciting outcome for the team at Green Collar. We spent close to 12 months looking for a global strategic partner to take our business to the next level. We've got very ambitious growth plans over the next 3 to 5 years, not only domestically, but globally across all the different environmental markets that we work in. And KKR was a brilliant partner because they could see very clearly, I guess, the growth opportunities, that this was a really, I guess, a relatively nascent market on a large trajectory in terms of capital investment and growth opportunities. So it's been a brilliant partnership so far. Next slide. Thanks, Sarah. In terms of what we do, just to touch on a bit about more of what we do. So we partner with landholders, land managers. We work with government agencies, corporate agricultural companies, mining companies to develop environmental markets projects. That's our role. So we're a specialist in environmental accounts. We do the end-to-end life cycle management of those projects, but we're predominantly a supply-based organisation. So we're looking to supply carbon credits and other offsets for corporate buyers, government buyers, to meet either their ESG obligations, sustainable development ambitions, or compliance obligations that they may have under different legislative arrangements. And we're also about collaboration and building partnerships. So we partner very much with research organisations such as the Wentworth Group, CSIRO, a lot of universities, Tropwater up in Queensland, to make sure that the projects we're developing are as robust as possible from a scientific standpoint. That's really critical, I guess, for the longevity of the scheme, particularly in an Australian context. But I'll probably leave it there for now, Sarah, and we can dive into some questions once we have the panel conversation.
Awesome. Thanks so much, Dave. Really helpful to hear. And last but not least, our surprise guest that probably many of you didn't know was coming is Matt from Cargill. So Matt, I will turn it over to you right now.
Sounds good, Sarah. Thanks. Hi there, I'm Matt. I'm based in the US and I work at Cargill. Just a little bit about Cargill, if you haven't heard of us before. We are an invisible giant in food and ag. We are about 155 years old. We do business in something like 125 countries with 160,000 employees around the world. And depending on how you measure it, we impact about a quarter of the world's food supply sort of throughout the year in lots of different ways. So put the next slide, Sarah. Just kind of describing some of those ways. We are everything but the farm and everything but the final good. So we connect producers everywhere with food companies and manufacturers and restaurants and so on that serve, but also increasingly with fiber and fuel and other bio-industrial products as well. There's a lot of work happening there to figure out where there can be plant-based alternatives to petroleum-based products today. And one area that I will call out here that we do not do is we are not in the business of manufacturing traditional ag inputs. So no seeds, no fertilizers, nothing like that. Farmers choose to do business with us every day. We are the revenue side of a farming business, and we see a lot of opportunities to take some of those same frameworks and apply them to opportunities for farmers to engage in new, let's call them digital crops, be they carbon credits, other ecosystem services, water credits, etc. So one more slide here, just to cover some of our sustainability commitments as a corporation. And this is a lot. It's diverse. We recognize that there is just a richness to farmers everywhere. Every farm is different. Every year is different for every farmer. And just like we bring market opportunities to farmers for grain, so we want to respect that richness and that diversity in bringing future opportunities to farmers in new areas. And really at the center of all this, we see the farmer as critical. I mean, this is an entity at the core who has not just cargo, but their financing and their equipment and their labor and their culture and their community and their knowledge and their expertise. And for deep systemic change to happen, we feel more than just point solutions are needed. And so we are looking for ways that we can identify system constraints and dissolve system boundaries and establish new connections. So and by way of my personal background, I worked in energy tech prior to Cargill and was in the US Army prior to that.
Awesome. Thanks so much, Matt. So hopefully you guys can all see the significant expertise on this panel. There's lots to get into, and I've already seen some questions coming through. So we'll hop into a bit of discussion now and definitely put your questions in the Q&A if you've got anything to ask. So I might start, actually, Matt, going back to you. When you're thinking about those sustainability targets and the kind of drivers and pressures and opportunities that a company like Cargill is facing, how does carbon kind of fit into that? How are you guys thinking about that, and why carbon in particular? What's exciting about it?
Sure. So, carbon is the lingua franca of sustainability. I mean, it comes up in so many areas and touches on so many elements. And that's often what we find ourselves being asked about externally. But when talking with farmers, it's as much farmer resilience as it is anything. It's, how do we ensure that farming operations have a chance to continue into the future as they might face increasingly extreme weather events and increasingly extreme market conditions? We need to have resilience built into systems to allow for that. So, we have done a lot of work, looking at different soil health programs and opportunities, and a couple of kind of consensus points there. One is that nailing down any particular outcome to any particular practice on any particular field is really difficult. But two, the more a farmer engages, the more practices that they might, choose to stack on top of one another, or the more they lean into the opportunity, the more powerful the outcomes we see. So hard to measure, and yet sometimes easy to see. And it really just comes down to, let's help farmers be successful, because when farmers succeed, the rest of us are successful too.
Yeah, great. I guess kind of sticking on that driver's point, Dave, you're nodding. What are you guys seeing in terms of kind of drivers for momentum in this space? And I guess kind of the KKR investment, I think turned a lot of heads of, real money coming into this space. And here in Australia, what are you seeing that's kind of changing nowadays and driving new capital into this space?
Yeah, sure. So I think one of the first points is, you need to be, like, we're unashamedly a profit-driven organization. We only think, if we think to see transformational change in a landscape, you need to be able to incentivize, I guess, the agricultural sector in certain ways to be able to undertake certain land use changes. And so I think what we're starting to see now is a broader recognition that environmental markets and agriculture are one and the same thing. They're not mutually exclusive elements on a different track. What we're about is saying to a landholder, what can we do to extract the most value out of the land use decisions you're looking to undertake? So, for example, when we looked in Queensland quite a few years ago around how do we try and use carbon markets in higher value landscapes, higher value production landscapes. And what we realized quite quickly is carbon alone as the only measurement of an ecosystem service in the Australian context was not enough to incentivize land use changes that needed to happen to have consequential benefits around things like water quality and improved ground cover and avoiding, erosion and things like that. So what we had to do was go, well, we're only pricing half the environmental benefit. We actually need to start pricing the other ecosystem services that come as a consequence of those land use decisions. So we actually spent the last 4 years designing and developing a whole new environmental market around water quality that's dedicated to the Great Barrier Reef catchments, that will actually pay landholders for management changes that they undertake on the ground that improve water quality. And what you can do is you can stack that with the carbon benefit, and that starts to actually go up the cost curve to incentivize landholders to want to make those required decisions. But to get back to your question, we're starting to see why we wanted to invest in the Australian context. We've got a really mature market in the context of global markets from an offsets perspective. There's a strong rule of law, strong property rights. It's got bipartisan support. So Greens, Labor and Liberal all support the carbon farming initiative. There's no sort of policy risk from that regard. And there's huge opportunity in Australia. Australia just geographically is well placed to participate quite well globally in being a supplier of carbon abatement across the land sector. So I think, and
I think that's a really good point there. And I don't want to ignore one of the other major incentives here, Dave, because you've spoken about incentives as well, right? And I know today is focusing on carbon markets, but there is a massive incentive in terms of consumer-driven
absolutely
carbon neutrality, and that's something that maybe we're ignoring a little bit. Is that consumers? I mean, we're all consumers anyway. We all eat food. We go to Woolies and Coles here in Australia and buy stuff. But how often do we look at, how that beef or how that box of cornflakes was produced in terms of sustainability and carbon neutrality or carbon positive, if you were sequestering carbon negative positive, if you're sequestering it more carbon into the ground than you are emitting. And this is actually, I think, a really fundamental thing, right? Because let's look at the market in terms of producers, 110,000 producers across Australia. How many of those are realistically going to enter into carbon projects, right? And where this is a broad spectrum from high-end supplying Coles and Woolies to hobby farmers. Now, we need another incentive outside of just carbon credits, because and I answered a question just before from a flower grower, which is actually, you flagged it, like if you've got 3 hectares worth of land, it's never going to be, under the current schemes, profitable to enter into a carbon credit project to improve carbon over 3 hectares. We see projects here in New England of minimum 200, 250 hectares. At least, given the risk, given the climatic conditions, and given what you need to do, given the small increase of carbon we normally get up here in New England anyway. So you need this other incentive. Now, I think there's got to be, we need the government looking at this other incentive. We need consumers pulling stuff off the shelves because it's carbon neutral or carbon positive. And I think that's there's a huge challenge there, because that all comes back to provenance and knowing where the stuff is actually coming from. I'd be keen to know Cargill's point of view on this, given you guys cover the full supply chain.
It's tricky. There's a lot of debate about where is the consumer preference, where is it driving, where is it headed. I think that we have seen a lot of shifts that track with changing demographics. And so there are certainly shifts that are predictable, but some of the sort of equally powerful demographic shifts are that rising GDP leads to rising protein demand in countries everywhere. And so, I think that it's important to bring in that language for consumers and give people a way to navigate it. I look at the relative success of calorie labeling in the US, and love it or hate it, what has been produced is a number that goes on food that people more or less account with good and bad. And I think that there is something like that can be paralleled here perhaps. And you see certain brands that are leaning into that in the US right now. But overall, I think personally, my view is that we're going to find more uptake as people expect the food that they pull off the shelf to be safe and free of rat poop and whatever, just like they will expect different sort of basic standards of their food in the future. So we'll see.
We're kind of talking about incentives here, and I think the point around, for a farmer, do I participate in a carbon market? Do I participate in something in my supply chain? Do I do a course to improve management practices? Should my agronomist help me? Who do I sell to? Like, it is really confusing, and I think increasingly so. I wanted to go back to the cost to participate point, though, that's been made a couple times, and I guess maybe, Alden, I'd be curious what different countries are taking different approaches. There's new technologies to kind of onboard farmers into these markets, but could you talk a little bit just about the challenge of cost to participate and how you see that changing in the future?
Again, it really depends on how you go about it. Between 2005 and 2015, worldwide, crop and livestock producers sold just under 14 million carbon credits over all markets, 13.7 of which were sold in one market, the Alberta, Canada large emitters market, where the prices buyers paid ranged from $12 Canadian through $30 Canadian. But on average, the actual crop producers net out of that marketplace was running $1.50 to $3 per acre. And then I'll leave out the details. The government went to fix that, and in their fix, with all the best intentions, created a market that became not viable at all. So it died. In our marketplace right now, and I got to say, our numbers are really anecdotal because our volumes are small and we can't make any guarantees. But for NRTs right now in our marketplace in the U.S., buyers have paid on average US $17.25 a ton, $17.25 a ton. Our costs and our costs cover the cost of quantification are running $2.25 a ton. The average project is generating 1 ton per acre per year, ranging from 0.7 to 1.1. And verification costs are running between 25 cents and 50 cents a ton. And in our marketplace, our verifier is the world's leading verifier in the traditional markets. We are not compromising quality. And the difference is how we do it.
Do you want to talk a little bit more about that? I imagine the next question will be like, what do you mean?
And all those numbers mean, so far we're delivering the farmer on average, say $12 to $13 an acre, which is a good return. Average US crop producer through 27 to 40 bucks an acre to the bottom line over the last 5 seasons. So if you add 13 to that, it's a pretty good deal. It's not a good deal for really small operators. So to make the market work, they've got to work with aggregators and data managers. In our marketplace, quantification and verification costs are much lower than traditional markets because we are using the reference network model informed estimation method, which means you don't have to hire a consultant and pay them $50,000 to interpret the 145-page protocol. And in verification, our verification costs are running about 10% of the norm in traditional marketplaces because we are using open source, continuously peer reviewed and upgraded quantification model, Platfarm. So we don't ask the verifiers to verify the quantification method. Our quantification method is a method that informs the US national inventory. So all the verifiers are verifying is that the people who claim they own the project actually do or have been assigned authority to control the project by the owners of the land, and that the data that they've supplied us, operating data they've supplied us, is reasonable and replicable. So when you go from very complex protocols that have 3 or 4 different approaches available to you to figure out how to set your baseline and estimate your incremental soil organic carbon stock change, and shift to an open source, continuously reviewed, transparent, informed model, then a whole bunch of verification and quantification costs are reduced.
I'm curious, Dave, how how are you, like, in terms of what you guys are doing? Like, I guess just to kind of summarize for people. So what Alden's talking about is participation in a kind of voluntary market that Nori administers, and using a Comet farm as the verification methodology. Dave, that's a little bit different than how you guys work, and Alden mentioned aggregators. Do you want to kind of explain how what you guys do fits in? And then Sam, I might ask for kind of comments from you, just so everyone sees how the pieces connect in terms of where you guys operate.
Yeah, absolutely. I mean, there's a whole range of different ways that you can account for carbon, and we work very much under the compliance market in an Australian context. So I guess in more of the traditional type carbon markets, where I guess offsets integrity standards, so legislative standards around sort of transparency and measurement, and sort of it's very much a regulated framework that we work under. So we apply methodologies that are all peer reviewed and sort of under legislation, or we design methods as well, and then we apply them working with landholders in particular properties. We create Australian carbon credits units that are all independently audited, and then we generally sell those units either to the government as a buyer, and they report on them for the United Nations targets, or as Sam mentioned, what we're starting to see a lot more of in the last 6 to 12 months is corporate organisations globally starting to take a very strong interest in net zero emissions targets or sustainable development goal targets. And so we're starting to see significant buying in that part of the market for voluntary reasons. But the key bit that buyers are looking to see is the integrity of the offset and what are the co-benefits. There's this term co-benefits that everyone talks about, and it's critically important to be able to explicitly measure and verify and demonstrate what the impact of that carbon project has been in relation to social and community benefits, if it's working with traditional owner communities, biodiversity benefits, water quality benefits. It's not enough to say, oh, these are these sort of amorphous, nice benefits that come from our carbon project. You need to measure and verify how those co-benefits are being generated. And that will increase the value of the offset. And so that's the sort of space we work in, I guess.
Yeah, great. And Sam, do you want to just close the loop kind of on how FarmLab fits into this, and especially around both voluntary and compliance markets? Like, how does what you guys do fit?
Yep. So we see the improvement. So let's take markets aside. I mean, we see the journey of the farmer in terms of their soil management journey starting before they even start to think about carbon, right? So a lot of our users come to us before they enter into a carbon project with a consultant. They'll start using the software, they'll upload a bunch of historic results because they've already been playing with soil carbon and trying to improve it in line with yield and the reduction of inputs, right? And then what we found is that they'll seek out somebody like Green Collar to embark on a formally registered project. Green Collar will then go and provide all the information around the different markets out there, the different ways you can improve carbon. And then we just sit there and we kind of act as that communication tool between somebody like Green Collar, the consultants, and the farmer. So the farmer can actually see what's changing and gets a visual picture rather than just hearing about carbon credits. And because there's a lot of complex, especially when you start to actually dive into the calculations, there's a lot of complex calculations that go into determining how much carbon has been improved per hectare based on a single soil sample, right? So it's very statistical. So we try and take a lot of that statistical maths out of it by just showing a picture and showing the changes of carbon over time and giving improving that communication. Now, taking out the carbon credit market thing, you can do this without having to, and this is really important. I think we recommend any of our users and agronomists do this, is start thinking about carbon long before you enter into a carbon project, because there are so many unknowns for a producer. Climate, which is always unknown, but you'll have a general understanding of your climate, although I think we'll be growing bananas here in Armidale soon with climate change. But that's a major factor. And then what you actually need to do to improve carbon. And I think part of addressing the risk to get more producers into carbon markets is giving them information and data and first-hand experience on what actually works to improve carbon. We've spoken to some of our users who've sort of come to us and said, look, I've taken soil carbon tests over the last few years for these, for my farm. Here's the picture. I don't know what's going on. I thought I was improving carbon, and then it sort of dropped off. And there's a big education piece there, because carbon isn't always going to improve linearly in a straight line even if you do the exact right thing, right? There's climate is often the biggest factor in this, and especially in Australia with drought. So, so understanding. So I really emphasize the communication piece. Whether you're using FarmLab or not, it's so important just to understand, to start thinking about it now and start taking those measurements. Unfortunately, carbon in the soil, and this kind of comes back, I think I'm going to try and address some of the questions here, because people are asking, why is it so conservative and so expensive to measure carbon and model? Well, carbon in the soil isn't like carbon in the atmosphere. You can't send a weather balloon up and measure carbon in one spot and get an answer for the southern hemisphere, right? Because carbon doesn't work like that in the ground. Soil carbon doesn't move around. It's usually paddock specific, so it depends on what you're doing in that specific paddock. And even beyond that, it's soil type specific, as Eldon referenced in the map. So there are a lot of complexities that right now the easiest way to solve that for carbon markets is just to measure everywhere, right? But we know there's a huge cost involved, and so understanding what you can do into extrapolating that out across the farm, maybe use a paddock as a test site, take some measurements, building up that picture will help, I think, people get more into carbon.
There's a bunch of nodding from the panelists, and so there was a few points raised there, but I wanted to go to Matt actually, and there's a question in the audience that relates to this, like if KPMG or Qantas are paying $40, like there's different ways for corporates to participate in this space, and Cargill's a corporate with farmers in their supply chain. How are you guys thinking about kind of voluntary versus compliance markets, and how to kind of play in the space?
Sure. So, one of I mentioned earlier that I think framing carbon as a crop for a farmer is an important place to start, especially when you consider that, on a farm by farm basis, it's likely that carbon as a source of revenue will never be the major source of revenue. It's going to be something that that an individual producer can produce, and it requires, inputs and expertise, and you worry about yield and pricing and so on. But all of these carbon products are fundamentally data products at their core. And so whether the data that you use to create the credit, and you call a credit a representation of data according to some protocol, whether you take that credit into a voluntary market or a compliance market or an insetting market or some other scheme, I would love to get to a point where there is flexibility and we can bring different market options to farmers, where maybe the rigor of measurement and verification from one program is different than what a farmer might align with for what they're ready to do, and so that's fine because there's another program that's ready in there. In general, we like to say that the quality of data is only something that can be measured against fitness for commercial purpose. And we see a lot of black and white data quality discussions out there around soil carbon that I think misses the potential just richness of commercial purposes out there. So KPMG at $48 a ton, great. With the government at a lower price per ton, maybe that's fine for farmers too. And different markets are fine because they can value that data to different degrees, much like different markets value different crops of different quality to different degrees today.
Yep. Go ahead, Alden.
I just wanted to make a controversial remark. We are focused on voluntary market. We got a couple of priorities, and one is, and the Alberta market I referenced earlier is an example of this. We think this is an important opportunity for food and fiber producers to get new revenues from outside the food supply chain. And we think that's really important because I don't know of any culture in the world where food and fiber consumers actually pay prices sufficient to cover the full cost of producing what they eat and where. So this is a one-time in history opportunity to diversify revenues in a way that could change everything for the food and fiber industry. That's the first thing. The second thing is, we are very focused on our market being a voluntary market, but we're hoping to inform how compliance markets work. And the things that you have to be really, really careful about and pay attention to, and here's the controversial thing, is traditional cap and trade as we know it cannot possibly scale up for this purpose. And I'm saying that as someone who was convinced for 20 years that we could scale it up. The reality is that in every existing cap and trade type compliance market that's been built by any government to date, every allowance or credit is counted at least twice. And in the California compliance market, every credit is 68% of the credits are counted or credited 3 times. So the dilemma we face is in California, buyers and compliance operators think they're paying $15, say $20 per ton CO2 equivalent, but they're paying $20 per certificate, the underlying value of which is no more than 1/3 of a ton. So the actual market price being paid in California right now is $60 a ton, but nobody knows it. Drives me crazy. So one of the things we're trying to do is create a market that shows how you can get true price discovery and actual credit tracing, so you can see that it isn't double counted in our marketplace. The other thing is in traditional compliance marketplaces and most, but not all, voluntary marketplaces, small independent buyers, families who want to offset their 12 tons a year, can't go to the markets and directly buy credits. And when they go through brokers, the brokers not unreasonably take 30 to 60% of the price they pay. We've designed our market so individuals can come and buy retail, and where brokers work in our market and aggregators in our market. But we have in our marketplace, we so far have over 800 independent buyers, most of whom buy less than 4 tons per person. And there isn't, and the percent of the total price the buyer pays that gets to the farmer is way, way up. So a lot of it's just market design.
Yep. There's so much to dig into, and I always regret that we don't have more time to chat on these calls. I'm going to go through maybe 1 or maybe 2 of the top rated Q&A questions here from the audience. So, from Matthew, one of the topics that's not talked about much is the issue of permanence. And it seems like with soil carbon market participation, it can create challenges that'll make it more complex for farmers to decide between alternatives, thinking about covenants over land and data access rights. What, do you have any comments? And Dave, maybe we'll start with you on kind of challenges and opportunities here.
It's a really good point, and particularly sort of speaking in the traditional sort of market that we have in Australia when you're looking at soil carbon. So, as a commercial developer, looking at how you can scale up carbon, when you look at the soil carbon method in particular, and I guess the complexity around testing, operational costs to actually validate the sequestration that's occurring in the soil, and you're playing that against the risks around permanence and the requirement legally to need to have some level of, I guess, security in relation to the asset to make sure that that carbon is being sequestered for a period of time. That's where it starts to get a bit tricky, because you're selling a financial instrument. That's what you're selling. It's personal property. It's like a share, right? And so you need to be able to demonstrate quite clearly that there's permanence, that there's integrity, and that if you're a developer taking on that risk, given the cost of development at scale, you need to have some level of understanding that that is going to be there over time, right, to manage that risk. And so I don't have a specific answer for that at the moment, other than to say it's a challenge that is currently being worked through, and it has been a pressure point in terms of scaling up soil carbon at the moment. I think there's probably changes in the model that can be looked at to maybe share that risk. But yeah, I think it is an issue.
Alden, do you want to quickly comment on that? I saw you nodding, and then we might wrap from there. No worries if not.
Another conversation about permanence and all of those things, but Dave's exactly right, and we work very closely and to get guidance from the U.S. Securities and Exchange Commission and Commodity Futures Trading Commission to the best of our ability, make sure that we're in compliance with their rules. I do want to say that we do need to help our governments figure out how to be part of the process of building a market where apples are traded for apples and not necessarily plums. And I'll give you an example. In most compliance markets, a whole bunch of emitters are allocated freely greenhouse gas allowances if their emission intensity is below an industry standard benchmark. So farmers who are being required to comply with a permanence test are competing in a market against free allowances that were issued to large emitters who haven't had to even reduce emissions to have that marketable allowance. I'm not saying that way of trading emission entitlements is wrong. I'm saying it's not an apple, it's a plum. And any kind of carbon drawdown and retention that meets even short-term retention tests is a more valuable commodity. We have to figure out how to make that evident, and their exchange rates emerge in our marketplaces.
I saw everyone nodding on that, and given we're out of time, I might leave it there. There's so much more to cover on this, and we'll definitely be sharing a few insights and tips from this, including slides from the panelists to everyone who registered. So Dave, Alden, Matt, and Sam, thanks so much for joining. Happy Ag Day to everyone, and really appreciate you coming along. We'll catch you next time.
Thanks.
Thanks, everyone.